Good afternoon, ladies and gentlemen, and welcome to the SHEARWATER Group PLC investor presentation for the 6 months ended 30th September 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Phil Higgins, CEO, and Paul McFadden, CFO of SHEARWATER Group PLC. Good afternoon.
Good afternoon, and thank you, Paul. Good afternoon and welcome everybody to our interim results presentation. Today, Paul and myself will be presenting to you, and we're going to start off with just giving you a little bit of an update as to remind you as to who SHEARWATER are and what we do. So SHEARWATER is an award-winning organisational resilience group that provides cybersecurity advisory and managed security services to help assure and secure businesses in a connected global economy. We divide our company into two divisions. We have a software side and a services side. And on our software side, we have our Secure Envoy and our GLN companies, who specialise in identity access management and data leakage technologies. On our services side, we have Brookcourt Solutions, Pentest, and Exena Consulting. Exena Consulting specialise in advisory services, Pentest in red teaming and penetration testing, and Brookcourt provides cyber solutions. We deliver our business through circa 90 employees across 6 offices, and we deliver our business through a 2-tier distribution model for our software business and a direct client approach on our services business. We look to attract the businesses of the global client base, Fortune 350 and 500 companies, government and SMEs. To give you some idea of the size of our market space, the global cybersecurity market is currently worth, depending on who you talk to, about 173 billion in 2020. And growing to $270 billion by 2026. Now, this is a recent publication that's in Forbes magazine on an article based from Australian Cybersecurity Growth Network. And it's within their input, they've assessed the global opportunity. The bottom line is, it is a big market that we're operating in. If I'll move you on. To give you an indication as to the visions of our company and the revenues and how they contribute to our bottom line, here I've got some charts here which will overview what we do. As I mentioned, the services division, we focus on blue chip companies. We are very big in banking and telco and technology. Our penetration testing company focuses on testing a lot of technologies for clients. And sorry, there's a notification came up on the screen and I do apologise. Our service division, as I was saying, we are very large in banking and telco and technology. Our penetration company focuses on delivering penetration services to technology organisations. We're fortunate enough to have Fortune top 10 software house as one of our clients, as long with corporates in the UK and internationally. Our advisory business focuses very much around the financial sectors and delivering security and advisory services to corporate clients. And the solution business focuses very much on the delivery of third-party technologies, bring them together and delivering those with a service wrap to our customer base. And this is indicated here with our managed services and warranty. As you can see, it's 45% that contribute to our group revenues. This is typically where we'd be selling solutions, and we would have a manufacturer's warranty, a technology set, and we would bring those all together and we would wrap them in our own service offering, and then we'd sell that through. These are repeatable, recurring revenues, and we enjoy long-standing relationships with clients. This type of business has been helpful during the COVID period. We specialise in an awful lot of key technology and critical infrastructure technology projects, which has pulled us through the current COVID crisis. The 17% refers to our software licensing, This is very much on our software side of the business through Secure Envoy, where they operate a two-tier distribution model. We have a contracts in place through distribution to an additional 350 plus resellers who represent our software internationally. And with recurring revenues there of circa 80%, when you look at the blended amount, we're pitching around about 40% as a blended revenue. It's reoccurring throughout our group. Obviously, at the start of the year with the COVID crisis, advisory did struggle. There's no denying. What we did find is that we didn't lose business. Business simply slipped. And I'm glad to say there's opportunities now with, since one additional contracting consulting services, we're seeing that the delayed and the slipped revenues are now starting to be fulfilled. And we'd like to think that we have got a suitable workaround in today's environment, albeit the face-to-face meetings have stopped, but we are running obviously more Zoom-based meetings with our client base. And our monitoring services and solutions is simply where we are engaged with some long-term clients and we provide monitoring solutions on a constant basis. I'm going to let Paul come back to why the software has grown, but just so you can see the highlight there. On a like-for-like period from last year, 35% to the first 6 months of this year, 41% of our adjusted profit margin there. But services, it's worth noting, a 5% to 8% growth line. That's contributed on a couple of things. One thing we're seeing is the quality of our revenues inside our services sector, where before we used to sell an awful lot of hardware-based technology appliances with applications that were built on top of it. The hardware side of it was extremely expensive. The margins were extremely thin, very small. And now what we're seeing is with a more move to a cloud environment, we're seeing our customer base wanting the software only and moving away from the hardware appliance. Various reasons, the cost, the expense, the running costs and so forth are all very much on the agenda as to why there's that quantum shift. What it means for us is obviously we lose some of that top line number, but we do gain in a better quality of margin for our group. Just moving on to geographical split, obviously with Secure Envoy's global reach through their reseller base, we can attract the businesses. Around about 36% of our revenues come from that position. Also, it's worth noting though, through our solution business, we do get involved with an awful lot of large corporates who would centralise their international rollouts from the UK. Those revenues would appear actually inside our UK business. So it is slightly skewed, and we will try and work to actually improve some clarity around those KPIs, where we can actually see if we can break out how much centralised revenues are here in the UK, and which are effective, obviously, in a more of an international profile. Just to give you some headlines, I don't want to steal too much of Paul's thunder here, but I'm very pleased to actually be able to announce that we've had a very robust financial performance, underlying EBITDA broadly in line with our expectations. We've got a strong financial position. We've moved from a position of net debt of 2.8 million to a net cash position of 3 million. Significant cash improvements. We are possibly the healthiest cash position we've ever been in as a company. So we're very pleased with that progression. Also, and I'll come on to this slightly later on, but we have a key development opportunity inside our roadmap. Our roadmap's been ratified by Gartner, and I will talk a little bit detail about that later. So some of those that have obviously seen that our top line number was down, that was partly, as I say, to the appliance-based technology moving to a software-based and subscription-based. But also, it's worth noting that on a like-for-like period between now and last year, our order intake was in line. What we weren't able to do in time was actually deliver through to the client base. Some of that delay is with the client in getting decisions, getting signatures on paperwork. Some of it was simply just late orders. So that is where we saw that. One good thing about all of this is we saw a tremendous start to October, started very confidently, and I'm glad to say that some of those orders that were waiting to be delivered are in the process or have been delivered. Also, during the COVID period, on the first 6 months, we have seen some very good wins. We've seen 62 new customer wins. 40 of those are in software. These are new logos. And within the services side, 20 of those are in our advisory and consulting side, and 2 of those on the solution business. The reason the solution business is low is the programs there do tend to take a long time in the sales cycle, whereas consulting can be a lot quicker to actually engage with. The good thing about the revenues from the software and the consulting is there's a high likelihood of them being repeatable. So it builds a good platform for next year. Also, it'd be wrong of me to not mention COVID, but it's worth pointing out that we have not used the furlough system. We decided as a company that offers resilience that we should test our own models, and I'm glad to say that they're holding up very well. We're very confident about being able to push through this COVID situation and not take advantage of the furloughing system. So all in all, we are tracking in line with our full-year profit expectation. Very pleased to be able to report that for you today. And with that, I am going to pass over to Paul.
Great, thank you, Phil, and good afternoon, everyone. I'd just like to take you through our financial highlights for the first 6 months of the year. As Phil mentions, obviously, trading conditions have been challenging for many companies in the first 6 months of the year. And it's very pleasing that we can report today that our underlying EBITDA of 1.1 million, which is marginally ahead of the prior year, is in line with our expectations. One thing that's worth highlighting within this profit number is we have worked to try and drive our underlying EBITDA margins upwards from 6% at this time last year to 10% at the end of September 2020. How have we achieved that? The improvement in underlying EBITDA is something we have been working hard to try and push, and the 2 main factors here, which I will touch on, have been within our gross profitability for both our divisions. We've seen some good improvements in both software and services. To give you an idea, our software business's gross profitability has increased from 65% in the previous year for the first 6 months up to circa 77% for the first 6 months of this fiscal year. And this has been driven as a result of some the changes that took place in the previous financial year, whereby we looked at the sales and marketing function, made some adjustments, and I'm pleased to say that actually that has yielded some better output, whereby we're getting more efficiency out of that sales and marketing function. On our services side, we've seen our gross profit margins increase from 20% at this point for the first 6 months of last year, and that's increased up to 24% for the first 6 months in the current year. This has been achieved as a result, as Phil's previously mentioned, a change in the mix of our revenues within our services businesses, whereby we have noted our clients are buying less hardware, which is characterised by high revenues but single-digit profit margins, and that has been in many cases replaced with a lower revenue but a better margin software solution sales. So it's pleased to say that both of our divisions have shown that improvement. In addition, improvement in gross profitability across the group, and we have made savings on our overhead base across the group of circa $500,000 in the first half of the year, of which a significant chunk of this saving is a result of the reorganisation that took place in the first half of the previous fiscal year, whereby we introduced a shared services function to the group. We looked at administrative functions, consolidated some of those parts, for example, payroll, our HR, legal, and we've been able to drive some administrative savings, which puts us in a good position as we grow. So obviously, as acquisitions come in, this platform will allow us to realise cost synergies quickly. Moving on to obviously this underlying EBITDA for the first 6 months of the year. Very pleased to report that we've been able to translate that into cash in an efficient manner. Our operating cash flows for the first 6 months of the year of 1.7 million demonstrates some continued good cash conversion, which we was fortunate to obviously achieve for the 12 months to March 20, and we've maintained that during the first 6 months of this fiscal year. In addition to the good operating cash flows, plus a small fundraise that took place in the first half of the year, plus the RCF, which currently hasn't been utilised, puts us in a more robust position as a business than we've ever been in the past. And as we look forward to the second half of the year, we go into it with much confidence, and as Phil's mentioned previously, that in a net cash position. We have opportunities, and we're in a good state of health. Obviously, we've achieved underlying EBITDA profitability in the period, despite, obviously, as Phil's mentioned, some of the challenges we've had on our top line, which has seen a revenue shortfall for the first 6 months of the year against the prior year. The two main factors around this shortfall has been delaying client decision making, whereby certain deals that we would have expected to be concluded ahead of the half year have been slightly prolonged and have taken a little bit more time to conclude, as well as obviously those that have concluded at the end of September, getting them out, the orders out the door, the physical deliveries and the fulfilment of the order has been slightly expanded, which has actually been one cause for obviously the shortfall at the end of September. Secondly, as we've touched on previously, have obviously had challenges during the initial lockdown. Many of our clients were in a position where contracts were delayed. Excuse me. Okay, apologies.
From you're fine there, Paul. Just to confirm, you're fine. We can see and hear you.
Okay, thank you. Apologies. Sorry, it's a technical glitch. Okay, one thing that we have noticed within our advisory business is, whilst clients still express an appetite to do business with us, we have seen some good demand for our penetration testing services in the first half of the year, and we have added 20 new clients during the period as well, which as we move into Q3, I'm pleased to note that a number of these engagements are now being fulfilled, and we are making up some of that deficits that we experienced during the first half of the year. As we move into the second half of the year, we've started H2 strongly. October, November have been very good months, whereby we've won and delivered new and renewed orders of a material nature, and this gives us confidence of achieving the full year numbers. It's worth mentioning, based on obviously these material orders that have come in, we now have good visibility to a significant chunk of the H2 target. So that we every day that goes by, we have a confidence that we can achieve our full year targets. If I could just move on to the next slide. Okay, I'm not going to go down every single line of this summarised P&L, but I just want to reiterate, obviously our revenue for the first 6 months has been impacted by delays, and I'm pleased to say that we are making these up, and we're in a good position and have confidence that we will hit our full year revenue and profit numbers. Highlighted obviously the improvements within our gross margins, which it's worth mentioning, both divisions have shown improvements in terms of their gross profitability. Obviously, overhead savings of 17% have obviously been discussed, and obviously the achievements of circa £500,000 savings have obviously allowed us and got us to our underlying EBITDA of 1.1 million. The only other 2 points I'm going to touch on here is the finance charge, whereby we've seen some reductions in interest charges in the first 6 months of the year, and this has been achieved from two main factors. Firstly, there has been repayments of loan liabilities in the first half of the year, which has reduced interest payable, as well as obviously following the introduction of the RCF in Q1, we were able to discontinue an expensive invoice discounting facility that the group had previously utilised. Just moving down the line to the depreciation and amortisation line, we have seen an increase in this during the first 6 months of the year, and this is due to predominantly within our software businesses, whereby we've developed software internally and released it. We are now starting to put an amortisation charge through the P&L. Moving on to the next slide, which is a summarised version of our cash flow for the first 6 months of the year. I just want to highlight, obviously, the strong cash flow from our operations for the first 6 months of the year, which is translated into free cash flows of circa 1.4 million for the first 6 months of the year. In addition to the fundraise as discussed, plus the RCF, which is in place, we've delivered some good, obviously, our cash position is in a healthy state. We've paid down some legacy loans, and we're in a strong position to move forward. It's worth mentioning just one other thing that happened at the end of September, which I haven't touched on as yet, is Phil's mentioned, obviously, we've had the level of inquiries has been strong, and pleased to say that at the end of September we finalised a contract for circa 3.5 million, which will be fulfilled in the first half of the next fiscal year. So whilst we have some confidence for the current year's revenue numbers, it's additionally pleasing that we now have some confirmed orders on the board for the next fiscal year as well. Without further ado, I'm going to pass back to Phil. Phil.
Thank you, Paul. Right, I'm going to just take you through some slides to overview our operations and strategy. So first of all, just a bit of a backdrop on what the marketplace looks like. I'm sure a lot of you have already seen this and agree with this. What we have seen, even before COVID, there was a shift towards more people having a more flexible working environment and working from home, working from remote locations and so forth. So we've seen that market space increasing. We've also seen, obviously, the effects of COVID speeding that up. We're all working from home. I'm talking to you today from my house. So with that in place, what we're looking at is obviously possibly a quantum shift in the way we our opportunities in front of us and the way we actually go to our work. We're looking to actually position ourselves as the authentication organisation that sits right in the front of that process. So we believe that there is a good market opportunity with our product set in this area. Also, we see that the security threats, the cyber threats themselves, if you listen to the NCSC and read their recent report, you'll see that 723 incidents between the 1st of September 2019 and 31st of August 2020 is up from the 590 in the previous period. And why is that important? These are significant events. These aren't the ones, the spams and the phishing attempts that sit in your inbox on a daily basis. These are the significant ones that affect our boundaries. So with the cyber threats increasing, it's obviously it plays also into our security softwares and also our security service offerings. We're also hearing from our client base that they're looking for a less complex technology. There's too many big tools needing too many big teams and the training, the cost, the expense, they're all too much. And what they're looking for now is a more less complex environment. One of the other issues that we're seeing is obviously the skill shortage. Whilst the government and the NCSC have got numerous programs in place to encourage young school leavers into the industry, we are still seeing a huge deficit in the skill set. And what we are experiencing is obviously the increasing cost of those skills throughout the sector, which is making some people take different risks, not pursuing certain components simply because of the risk. It's also helping people to move away from certain technologies into other. So the cost of the skill set is obviously affecting the overall solution. And obviously the compliance side of things. Fines are increasing. The BA fine of back in 2019 was cited at around about 183 million. I believe that's just been settled, or around about the 20 million. If you read the ICO report, it actually refers to the reduced fine being what it is simply because of the effects of COVID and what that's had on their operation. Now, it's interesting to see that the ICO still found it a requirement to actually sue or fine British Airways a significant amount of money during a period of such economical difficulty. And of course, we got the economical period in front of us. We've got Brexit. We've also got the tail end of COVID, and obviously the effect that's all having on us all. So what we need to do is make sure that we have our services and solutions which can help our corporate clients address these components. What I'm going to take you through here is just a little scenario of one of Brookfield's customers. It's one of their key tier 1 banks, HQ'd in the UK, although they do have a global presence. Brookfield have been working with them since 2005, and they have a big framework agreement in place with them, where they've been providing security services, resources, cyber technologies, threat feeds, analytical technologies and solutions, building big programs to defend the users of the banking technology. We've been enjoying that space there for many years. We've grown with the customer, and we've been working with them, and to the point of becoming a trusted advisor. We work with them to actually identify new innovative technologies, as well as providing these through and managing it through its life cycle. When Shearwater acquired the assets of Brookfield, it presented an opportunity. And as we moved into phase 2, what that allowed was for us to introduce the sister companies, Pentest, Secure Envoy, Geolang, and Xena to the client. This is a tier 1 bank. It's very difficult to actually penetrate an account like that and remain with them. And we've been with them for 15 years. And what we've found is that with them, we can actually present our sister companies through to the customer, and we can give them the stage where they can present what they offer. And I'm pleased to report that at the moment we have 2 software companies. One is has a technology in POC, and the other one is in conversations at a global level. Now, obviously, a company this size, this opportunity, would certainly move the needle for one of us. And when you consider how many corporate clients that Brookfield have, it allows for us to introduce and if you like, extract as much value out of our client base on the services side as possible, and sharing that with the rest of our sister companies. The revenues there are very important, and typically the consulting and software do yield a better return. So obviously it makes perfect sense for us to make this introduction, and hopefully they can actually conclude business. Now, obviously the type of activity they're involved with allows for a lot of recurring or repeatable business. Whereas with solution business, you provide a solution and it's in and it's working, and then the revenue may tail off and get reduced simply because there's no capital purchase left. And then 2-3 years later, it may get renewed again. So you can see how the sine wave would work with solutions. Obviously with Pentest, Secure Envoy, Geolang, and Xena, where their services and their product set do attract a recurring opportunity. And as we move into phase 3, we're looking obviously to expand our sister companies across all of our client base, which will help extract the much of the revenues that otherwise Brookfield would have left on the table for someone else. To move you through onto a little bit about our software market space, and I would like to just overview where we're aiming to be from a software position, to give you some idea of where we're moving. So what we're looking to be, on this diagram here on the right hand side, you'll see this IRAD, the intelligent reporting and anomaly detection. We're looking to position ourselves here. If we can agree that the first thing you do when you log on to your corporate line, to your banking applications, to your social media, to procurement portals, is you have to authenticate. If that's the first thing you do, then that's the space where we want to be. It's one of the biggest markets out there. It's becoming more important. The more we work from home or remotely, we will be dependent upon the authentication process, making sure we know who's on our network and where they're going. So it's quite simple. And a lot of these components that sit around this our acquisition are instrumental in helping secure and creating that identity management. So a couple of things that we're seeing, as I mentioned previously, that we've spoken to our corporate clients, and we're seeing obviously a need for increased security for themselves and for their customers. GDPR is pushing more requirements for security, as is the regulators. So we're also seeing that the customers want a more simplified technology. It's getting too much, too big, too deep, too wide, and they want something where they can work with, and it's a broad type of tech delivery. What we're also seeing is the increased compliance and regulatory requirements about control, monitoring, reporting, and being aware of where the networks are, and making sure you know where your users are, and making sure that you know where your data is, and should any of that change, there are obligations, obviously, to report that through to the regulatory bodies. And of course, the most important one for a lot of the customers is to reduce costs. So what we're looking to be is the leading security as a service provider on converged platforms. So to give you some idea, this is an example here. So we are going for, our strategy is a breadth versus depth type of approach. And along the top here are some of those components that I mentioned on the previous slide. So we've got multi-factor authentication, privileged access management, identity access management, cloud access security broker, and data loss prevention. So these are the key things that we see are a must-have for security and compliance requirements as a bare minimum. This is the thing that sits there that helps control your safe journey onto someone's portal or accessing data inside your network. Below that, we can see a group of well-known logos from leading organizations, big global companies who focus on the top end of the Fortune client base. They are also known for deep diving technologies. They're very good at particular things. Also, it's worth bearing in mind that some of these technologies do spread across the complete product range, and they are looking obviously to expand themselves. Some of them are trying to do that through acquisition, which is a very expensive activity for them. When you consider that these guys are very much focused on the big global Fortune 100, and we're quite happy to leave them there fighting amongst themselves on that revenue stream. At Secure Envoy, the team down there have been very instrumental in developing a platform. When SHEARWATER acquired Secure Envoy, it did one thing. It was a multi-factor or two-factor authentication device. And I'm glad to say that the team there have lifted the product from an on-prem to be in the cloud. They've created a platform, and they've got multi-factor authentication, meaning that it's more than just two-factor. They have different methods. They can secure your laptop, your PC, your Palm Pilot, your mobile phone, through different methods. Also, we have identity access management, which is developed internally, and that is now as a feature that sits on top of the platform. And also, moving over to our data loss prevention, we have integrated the technology of GeoLang onto our platform, which means now we can deliver a more broader offering to our client base, and we can attract new customers with this. And we've started to see our first set of customers inquiries come through, and I'm glad to announce that we have additional capabilities that we're focusing on, which are very active at the moment. And they sit here in the PAM and the CASB space. This presents us with a strategic opportunity for acquisition, and this is where we've been looking. And I'm glad to say that we have identified a number of companies in this space, and we'll continue to pursue those opportunities. We're also running a development model here. So should there be a opportunity to develop in front of the acquisition, then we will do so. we will continue with our plans. They've been funded and budgeted, so they're within inside our capability. This here answers a lot of the questions that we're seeing from the clients, where they're looking for a broader platform, a more simplistic approach, one that provides the relevant managed risk for the client base and the relevant amount of protection that the clients have been looking for. We took this model past Gartner, and I'm very pleased to report that Gartner have said that Secure Envoy's product roadmap really fits with our predictions that by 2023, a new category of SaaS-delivered converged identity access management platforms will be the preferred adoption method for information governance, assurance, and privileged access management in over 45% of new identity access management deployments. As you can see, it is a huge opportunity for Secure Envoy, and I do congratulate the team for actually giving us this opportunity to talk about this today. They've done a tremendous job, and I'm very pleased to actually have the management team in place delivering this today. It's been ratified by Gartner. We are not current clients of Gartner, I will add, so this was given to us from their initial views of what we deliver and our roadmap into the future. Hopefully that gives you and answers some of your questions of where we're actually focusing and why we haven't necessarily made acquisitions in this space at the moment. It's simply the case of we've been filtering through and looking for the right type of organisation to acquire. We will spend our time in negotiations with organisations to see if we can actually conclude. Unfortunately, I'm not in a position to actually give you a timeline on that. Moving on. I've noticed there's a number of questions, and this is the last slide before we get to some of those questions. So I just want to sort of really recap on some of the things that have been mentioned today. We're reporting once again a good profit position. At the beginning of the year, because of COVID, what we did do is we suggested to the city that we're actually going to be a flat year, meaning it would be the like for like from last year. And the only reason we did that was simply because of not knowing where COVID was going to take us. I'm pleased to report, obviously, with a slightly bumpy tail into H1, H2 has started off with some very significant contracts, and that have been signed, and we've got new customers that have come through, and we will see those new customers start, as we start moving through the delivery process, they will start feeding their balance sheet. So hopefully we'll be able to report on the returns of those new opportunity wins that I spoke about earlier on. Paul's also mentioned that at the tail end of H1, we concluded a significant piece of business which is waiting for deployment in the first half of next year. Also, we've been analysing obviously the slippage orders, and that we believe that our slipped orders will be delivered and caught up by the end of this fiscal year. So that from the catch-up period, we believe is should put us back on track where we expect to be within our forecast. Obviously, to move things forward, we've also integrated some of the technologies of GeoLang onto our Secure Envoy platform. Why is that important? It allows us to take a technology and put it onto a global stage. It's very good technology. The team there worked tirelessly to actually deliver something that's very unique to the industry. And obviously, we're now in a position where we actually give it a global platform for us to be able to present that through our 350 resellers globally onto their client base. So in conclusion, we're on track to deliver against our market expectations. We're a profitable company, we've got a good team, and we're doing well. We have been slow on our M&A, but we've been very selective. We do have key criteria. We are obviously, from an organic perspective, we're targeting large corporate clients, and we want to leverage our existing client base, and we want to obviously enhance our core competitive position by producing new technologies and new services. But obviously, Shearwater as an investment model also focuses on the M&A. And whilst we're looking for feature-rich add-on companies, we're also looking for large service-based organizations as well. And one thing COVID has done, it's presented an awful lot of opportunities to us. we have seen a high number of opportunities come through, and to be honest with you, they do not meet our strict criteria. We were looking for profitable or near-term to profit companies, cash generative, and they also need to be a strategic fit. There's no point us doubling up necessarily on their software when we've already got some program in place. So we're going to be very selective. We're going to continue to do that, but we will try and accelerate our roadmap and our M&A. So in conclusion, we'd like to suggest that our market space does offer some plenty of opportunities for growth, and the Shearwater group of companies do offer a significant long-term prospects for the organisation resilience market space. We're driven by the increase in security risks and the increase in compliance requirements. And with that, I would like to thank you very much for listening to the first part of this, and I'm going to hand now back to Paul, where we can move on to some questions.
That's great. Phil, Paul, thank you very much indeed. Ladies and gentlemen, do please continue to submit your question using the Q&A tab situated in the right-hand corner of the screen. I would like to remind you that a recording of the presentation, along with a copy of the slide and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform also. And lastly, before we hand back to you, Paul and Phil, I'd like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order the company can better understand your views and expectations. Phil, Paul, obviously we've had a number of questions that have come in today, some of which I think you've kind of touched on in the presentation, but perhaps I could just pick a few of these out and just ask them to you, and you can just direct them, Phil, to who's probably best to answer it. You just recently touched on this towards the end of the presentation, but how is the acquisition pipeline looking? And is there a reason why you haven't made one for a while? And I appreciate you just touched on a little bit of that towards the end. If there's any more colour you can add, that'd be really great.
Certainly will do. Okay, so the last acquisition we made, we acquired certain assets of Sakama way back in, April 2019. That was also the time when I became CEO. So we had to focus first of all on bringing the health back to the company. We had some changes we had to make, and we did those, and we wanted to obviously bring create more strength to the group. Since then, we've also been keeping our eye on the acquisition market space. We've had to look very critically at some of the companies that have come across our desks, and they just haven't met the criteria, to be honest with you. We do not want to be buying companies which need fixing. We don't want to be in that position. We've now got a very strong balance sheet, we've got a strong company, and we want to spend our money wisely. We want to make sure that we're not creating any dilution to the existing shareholders. So with all that being said, we've been very fussy about what we want to buy, but it's also got to be very strategic in terms of where it fits, as I mentioned. In terms of what do we have at the moment, we're probably seeing 1-2 companies per week that come through to us, and there's obviously changes in the entrepreneurs relief and corporation tax, which is prompting some companies to sell out. What we look for is obviously the strong management team underneath the owners to make sure that we've got a good team to carry on. As you know, we keep the logos of the organisations with inside our branding, and we'll be looking to acquire companies that where the management teams are of suitable strength, where they can actually come with us on the journey, where their balance sheet is a positive contribution to what we do, as well as being a technical or service-based strategic fit. We do have a number of companies that we're looking at, that we have had spent quite some time with. We have noticed that some very good companies had delayed their decision making simply because of COVID and Brexit. They want to wait and see if they can get better valuations once all the problems have cleared. And we'll carry on talking to those companies. Hopefully that gives you some answer around why we haven't made an acquisition for a while.
That's great. Thank you very much, Phil. We've had a few questions through with regarding share price in sort of different forms, but if I could just sort of take the shortest one, really. Why is the share price where it is?
Okay. Let me take that. Yeah, that's a very good question, and it's a hard question. I can't really comment too much on share pricing. I'm here to run the company and build the company. But I will say this: we're in the best financial strength that we've ever been in, which makes it bizarre that share price has been taking a tumble. Every now and then, depending on the environment, obviously, if institutions or individual investors sell shares, obviously it affects the price. I will say this much: that when you look at the executive board, we have a significant position. Paul, is it about 22, 23% of the shares are held at the board?
So 17% at the board, but the board and management circa 30%.
So you can appreciate we're there, and I can assure you that the board of directors that own shares have not sold, and we strongly believe in this company. Our institutionals are a great support for us, and they understand what we're doing. They're very pleased with obviously the fact that we're a profitable company, and I'm surprised that our share price has taken tumble the way it has. The top line numbers, I think, may have been the thing that has spooked people, but needless to say, we look to actually recover all of those. Some of that work's already happening. The deliveries have been pushed through, and we're seeing a good percentage of that already being completed this quarter, and we expect that to be caught up by end of fiscal year. So I imagine that that may answer the question or some of the uncertainties for some of the shareholders, and I hope that they will come back into us.
That's great. Thank you, Phil. Next question we've got is a bit of a long one, but just refers to Interseed. Interseed have just had an update that's similar to yourselves, referring to delayed contracts, understandably. They describe themselves as having a niche high-end position at the top of the security market pyramid with American government department clientele. They're looking to enter the wider, more general market now. How would you describe your market demographic? Is it specific to regional sector, i.e. financial, home, remote office? And do you have a product that could be described as niche, or is it more directly competitive?
Okay, well, yeah, Interseed, they attacked the market slightly different to us. We do have obviously some crossover. They're very much on the KPI solution, the public key infrastructure. So there you tend to, it works very well with certificates for identity, and there you need software and readers, card readers, things like that. So I can understand why they're big in US government and places that need that type of security. For ourselves, we don't necessarily go after a particular vertical. We go after a particular problem, and what we're looking at is from a functional perspective. Whereas we will be looking for obviously providing that complete identity access management platform and the services, the complementing services around that. We will no doubt have some competitive position against them. We already do sell our products to the UK government in various different shapes and sizes, and what we will be looking to obviously is penetrate further into that sort of space. We do have additional development coming out during the year, where we'll hopefully be able to announce new products, and what we're looking at is obviously moving possibly beyond the basic sort of card and reader device into more advanced biometrics and things like that. So it is an interesting space. It is a big market, and for us, we're very much focused around that corporate client base. Now, because we have a two-tier distribution model, we have in excess of 350 plus resellers around the world. So we've got many people out there selling on our behalf. So geographically, we're probably in, I want to say circa around about 30 countries where we're active, I would say, selling our software, and obviously we'll be looking to grow that over the coming years.
Fantastic, thank you, Phil. Another one we've got here, a couple of questions in actually around the margin. What opportunities are there to improve on your profit margins?
Let me pass that one over to Paul. I think Paul, you can probably answer that one.
Yes, of course. No, I think it's probably worth mentioning that we feel there are obviously opportunities to work on the underlying EBITDA margin within the overhead base. Many companies, I would imagine at the moment, are looking at some of their fixed costs, things such as their offices, to see whether or not they still require all of those. It's a similar consideration is being given by us. We continue to look at our supply base, and we have in the first 6 months of the year been able to make some additional synergy savings within our supply base, and there remains some opportunities for some further savings there. Obviously, we've got to be slightly careful not to cut costs too much on the overhead base, but there are some opportunities there that we can look to obviously consider. I think probably the area that's probably more interesting is actually if you look at within our divisions, our software division and our services division. I think we both feel there is an opportunity to improve those gross margins within the trading businesses. So, for example, within the services businesses, obviously we've demonstrated and we've achieved some improvement in the margins for the first 6 months of the year, and this has been achieved at a time whereby our advisory businesses have obviously had some challenges from the wider world and with the impacts of COVID, which has impacted some of our utilisation rates. I feel there is an opportunity there potentially. But as we sort of move out of the COVID and the advisory revenues look to recover, that should give us an opportunity to push our margins. And it's worth noting that towards the end of Q2, we did actually invest in some additional sales and marketing resource to further drive those advisory revenues in the future. So there is an opportunity there within the services division for improvements. And moving on to the software division, it's worth mentioning, obviously, with a number of new product sets coming online, which obviously there is a huge opportunity essentially for us to push that margin, which 12 months ago we was around about the sort of mid-30s levels in terms of underlying EBITDA margin. We've improved that up to circa 40% at the end of September 20. And obviously moving forward, as more and more of our products come online, obviously our software businesses working closer together, we obviously have opportunities whereby we can add that incremental upsell to existing and new clients, which will drive which one would hope would drive the margin upwards.
That's great. Thank you very much, Paul. Next one we've got here is you haven't announced any major contract wins. Have there not been any?
There have been. We have obviously at the beginning of the fiscal year, we forecast through a flat year, like for like from last year. And obviously in that we analysed our client base, our opportunities, and we saw the repeatable, the recurring numbers, and we included all of those into our forecast. Obviously, we also look for the amount of conversion of new clients and activities there. So everything that we had in H1 was within inside our forecast. Obviously, it would be we were expecting that to come through. It'd be wrong of us to announce an RNS about a new win if it had already been forecast, as it were. But now, obviously, we're catching up on those opportunities, and we had one right at the tail end of the year, which has obviously allowed us to, if you like, bank an order starting from April 1st of circa 3.6 million. That one was included in the most recent RNS to do with these interim numbers. So we have been winning. We were expected to win multi-million-dollar deals. on a regular basis, and those have been coming through. We haven't had any that have been material outside of our forecast or of strategic importance to communicate through to the industry sector. What we have is obviously the clients and the expected and the forecast bids and business that we had sight of. And obviously, as we move through this fiscal year, we do see some opportunities out there which we will continuously bid upon. And should we be successful, we certainly will let the audience know if they sit outside of our expected forecasted business.
That's great. Thanks, Phil. So we're just approaching the hour. I think we've got time perhaps to squeeze two more in, if that's okay. And I know you want to get some feedback, so I'll be quick with this one. You still seem to have a lot to do to reach a flat number on last year. What has given you confidence in achieving that?
Well, let me start off with that, and I'll pass over to Paul as well, so you can get the CFO's viewpoint on it. But for me, obviously, we're seeing a workaround to some of the COVID situation. We're involved with some critical projects and critical technology, which is putting us through the COVID challenge. And so we're still delivering those. We're involved in things like 2G, 3G, 4G, and 5G. We're involved with security desks at major retail banks. So these are the types of things that actually help us come through. We've seen an increase of traffic coming in. We've seen you could say the sales pipe has been filling up. The conversations are starting again broadly across the business to include consulting as well as the solutions. So we're seeing a more encouraging start to the half year. And I think a lot of that is to do, obviously, with people's acceptance now of the COVID workaround, and we all want to carry on with what we're doing. Maybe Paul, if you can just give a few moments on the numbers coming through that you can see, or not so much the numbers as a forecast, but in terms of the confidence around that.
Yes, no, of course, Phil. I think there's three things for me that I'm seeing through that give some confidence. And firstly, obviously the fulfilment of orders that were delayed from the first half, which I'm pleased to say in Q3 we're now starting to fulfil, which is obviously allowing us to catch up some in terms of from a recognised position. In addition to this, October and November have been strong months for the business, with a number of material new and renewed orders confirmed and in many cases delivered, which obviously with these coming in, this does really give us some additional visibility for the full year. The other thing that's worth mentioning is obviously a chunk of our revenue is of a recurring nature, and it's worth mentioning December, January, we do have some good renewal periods. So I think those 3 points, obviously the delayed orders from H1 now moving through. Secondly, October and November, new and renewed orders of a material nature in the bag, and also obviously renewal rates, obviously our recurring revenue streams and those expected renewals for H2 give us some good visibility on a significant chunk of our H2 target. So yeah, there is a confidence that we can achieve the full year number.
Thanks, Paul. I did say there would be time for one more. I know we're just going up to the hour. Phil, perhaps I could just pop this one and we'll direct to investors for feedback. The Secure Envoy platform holds patents. Could you detail the level of protection for its offering and a brief commentary on how Secure Envoy solution fares against competitors in terms of barrier to entry, unique selling points, and any other competitive advantages? Do you see the scale of Secure Envoy continuing to accelerate rapidly?
Wow, that's a big question. I'll try and be brief on this. I know we're on the hour. So we have across our softwares, including Secure Envoy and GeoLane, a total of 10 patents with 4 pending. And I will have to come back to you and possibly respond in writing some more detail about those patents. But obviously, Secure Envoy, what we tend to do is we're an independent company, so Microsoft offer authentication technologies, but they only do one thing. They look after themselves, and whilst they can connect into other areas, but they're predominantly focus their engineering around themselves. What we're looking for is we're a non-partisan platform, so we can connect into many things. And so, from a competitive perspective, when you've got some big companies out there who focus on themselves and access to their technology, that's fine. Also, those where they develop out into across the market spread. We're also seeing that those bigger companies are focusing, as I mentioned, exclusively into the really large corporate client base, the tier ones. Now, if the tier 2s, 3s and 4s are the next level of customers that are available to us, they're still international by nature. So we will continue to go after those. We will look to actually develop our software as a platform which can connect to many organizations and not be restricted. So that is our strategy, which is slightly different to that of some of the bigger players. Does that answer some of that question?
Thanks, Phil. I think obviously we have coming up to the hour, and thank you very much for answering those questions. I'd also like to remind investors, of course, the company review all questions submitted today, and perhaps we could add a little bit more to that one, Phil, when you get a moment. And we will publish those answers on the Investor Meet Company platform where appropriate to do so. Phil, just perhaps a couple of closing comments before I redirect investors to feedback, please, if you could.
Yes. So obviously we've come through an awful lot of change in the group. We are a strong cash generative company. We're profitable. We've got a fantastic team, got some great talent inside the organisation. They're heavily incentivized to point to success. We're all pointed in the right direction, and I'm glad to say that it's now yielding the results. We are looking obviously to continue with our M&A activities, and we hope that it won't be too far off into the distance when we'll be able to come back to you and actually talk to you about acquisitions. Until then, I would like to thank you for your time and your interest in our company. And if there are any other questions, then obviously we will try and get back to you in writing with those, and we get those all published for you. So with that, I would just like to thank you for your time in listening to us today.
That's great. Thank you again. Thanks, Phil. Thank you, Paul, for updating investors today. Could I ask investors not to close the session, as you will be automatically redirected for the opportunity to provide your feedback. If you've accessed the meeting from the website, the feedback page will appear in front of you. If you've accessed it from the link sent by an email, you'll be asked to log in and submit your feedback. It only takes a couple of seconds, and it's much appreciated by the company. So on behalf of the company, thank you very much for attending today. That concludes today's session. Thank you. Good afternoon.
Thank you.